Many traders adopt a single screen or indicator that they apply to each and every trade. In principle, there is nothing wrong with adopting and adhering to a single indicator for decision making. In fact, the discipline involved in maintaining a focus on a single measure is related to the trader's discipline and is, perhaps, one of the main determinants of achieving success as a trader. What if your chosen indicator is fundamentally flawed? What if conditions in the market change so that your single screen can no longer account for all of the eventualities operating outside of its measurement? The point is, because the market is very complex, even the most advanced indicators can't work all of the time and under every market condition. Choosing indicators, for example, in a market uptrend, trend-following indicators rise and issue buy signals while oscillators suggest that the market is overbought and issue sell signals. In downtrends, trend-following indicators suggest selling short, but oscillators become oversold and issue signals to buy. In a market moving strongly higher or lower, trend-following indicators are ideal, but they are prone to rapid and abrupt changes when markets trade in ranges. Within trading ranges, oscillators are the best choice, but when the markets begin to follow a trend, oscillators issue premature signals. To determine a balance of indicator opinion, some traders have tried to average the buy and sell signals issued by various indicators. But there is an inherent flaw in this practice. If the calculation of the number of trend-following indicators is greater than the number of oscillators used, then the result will naturally be skewed toward a trend-following result, and vice versa. Elder developed a system to combat the problems of simple averaging while taking advantage of the best of both trend-following and oscillator techniques. Elder's system is meant to counteract the shortfalls of individual indicators at the same time as it serves to detect the market's inherent complexity. Like a triple screen marker in medical science, the triple screen trading system applies not one or two, but three unique tests, screens, to every trading decision, which form a combination of trend-following indicators and oscillators. One of the interesting features of the foreign exchange market is that it is open 24 hours a day. Around-the-clock trading allows investors from across the globe to trade during normal business hours, after work, or even in the middle of the night. However, not all times of the day are created equal when it comes to trading forex. Although there is always a market for this most liquid of asset classes called forex, there are times when price action is consistently volatile and periods when it is muted. What's more, different currency pairs exhibit varying activity over certain times of the trading day due to the general demographic of those market participants who are online at the time. In this article, we will cover 3 major trading sessions, explore what kind of market activity can be expected over the different periods, and show how this knowledge can be adapted into a trading plan. Having studied Units A and B, you should be familiarized with the forex market to the extent that you know who participate in it, the reasons why participants chose this market and how you can emulate them. Moreover, you should also be able to pick the best setups, the optimal time to trade those setups, and know a lot of guidelines about how to trade them. However, and because there are exceptions to analytical guidelines without which market analysis would be a science of exactitude, not one of probability, you need a structured approach, in other words, a trading system. But what exactly is a system? The point of this chapter will be to give you that information as clearly as possible, and to bring you to the next level in your education, showing you what this amazing subject has to offer. Be prepared for a challenge. This learning stage is different than the analytical approach you learned in Unit B. Besides mastering good analytical skills, success in forex requires a systematic way of making trading decisions. First, we will go through several definitions of trading systems. You will learn that a system is basically a methodology that you adapt to a certain market characteristic. The second section will help you understand that a structured trading approach is about creating and following rules, with a keen sense of observation and discipline. To consistently make money in the forex market, you want to have a set of trading rules that guide you through your decision making. This will separate you from the market gamblers and give you the structure to become a professional trader. As always, we will make it simple for you by building a trading system from scratch that you can use for your first tests. This will be the focus of the third section. New traders are regularly fooled by expensive, holy grail systems, and perhaps you are looking for it too. You have to be realistic when searching for a useful system and consider if you really need to buy one. Some systems are very hard or impossible to understand. Only by understanding the methodology of the system, you will be able to effectively use it at your advantage. How can you follow something you don't understand? In the last section, you will learn 2 methods for evaluating and fine-tune any trading system. 1. Definition of a trading system. A trading system is a set of rules that formulate buy and sell signals without any ambiguity or any subjective elements. These signals are mostly generated by technical indicators or combinations of technical indicators. The primary aim of a trading system is to manage risk and to increase profitability in any market environment. Optimal levels of risk and reward are accomplished by modifying the different parameters within each rule of the system. A benefit of trading with a system is the removal of emotion from trading. Systematical trader will, for instance, not place an excessively high-risk trade due to frustration from a prior losing trade. But there are many other benefits to extract from a methodological approach, as you will see later. No system is better than another, but a good system is one that is adapted to